For a long time, business success in the US followed a clear and widely accepted formula. Grow revenue fast, expand market share, beat quarterly expectations, increase valuation. Companies that moved quickly and showed strong top-line growth were celebrated as winners, even if profits were thin and risks were piling up beneath the surface. In 2026, that definition of success is being rewritten. Across the US economy, business success is no longer measured primarily by how fast a company grows, but by how well it holds up over time. This shift did not happen overnight. It is the result of repeated shocks, tighter financial conditions, and a growing recognition that speed without resilience creates fragile businesses. Leaders, investors, and employees are recalibrating what they consider a successful company, and the new definition looks far more grounded than the one that dominated the previous decade. One of the biggest changes is the reduced emphasis on pure revenue growth. Revenue still matters, but it is no longer enough on its own. Growth that depends on heavy discounting, rising costs, or constant external funding is viewed with skepticism. Businesses are now judged on the quality of their revenue. Is it recurring? Is it predictable? Does it generate cash? These questions matter more than how fast the top line is expanding. Profitability has also regained importance, but not in the short-term cost-cutting sense. Sustainable profitability is the new benchmark. Companies are expected to demonstrate that they can earn money consistently without burning out their workforce, degrading product quality, or relying on temporary advantages. Profitability is seen as proof that a business model actually works under real-world conditions. Cash flow has moved to the center of how success is evaluated. In earlier years, cash flow was often treated as secondary to growth potential. Today, steady cash generation is viewed as a sign of strength and credibility. Businesses that can fund operations, invest selectively, and weather downturns using internally generated cash are considered far more successful than those dependent on constant financing. Balance sheet strength is another pillar of the new success definition. Strong liquidity, manageable debt, and financial buffers are no longer seen as conservative or inefficient. They are viewed as strategic assets. A company with a strong balance sheet can make decisions calmly, invest through uncertainty, and avoid reactive measures during downturns. That flexibility is now a key marker of success. Longevity has entered the conversation in a way it rarely did before. Businesses are increasingly judged by how long they can sustain performance, not just how high they can climb in a short period. Leaders are asking whether their companies can still function effectively 5 or 10 years down the line, even if conditions change. Staying power has become a competitive advantage. Operational resilience is closely tied to this shift. Successful companies are expected to handle disruption without collapsing. That includes supply chain shocks, labor constraints, regulatory changes, and demand fluctuations. Businesses that continue delivering reliably despite these pressures are now seen as better managed than those that post impressive numbers only in ideal conditions. Customer relationships have taken on greater importance as well. Success is increasingly defined by retention, trust, and long-term value, rather than constant customer acquisition. Companies that keep customers satisfied over time are viewed as healthier than those that rely on aggressive marketing to replace churn. Durable demand is valued more than rapid but unstable expansion. Workforce stability is another part of the new definition. Frequent layoffs, extreme hiring cycles, and burnout-heavy cultures are no longer seen as signs of agility. They are increasingly viewed as indicators of poor planning. Businesses that manage growth without constant disruption to employees are seen as more sustainable and better led. Investment strategy has also evolved. Success is no longer about how much a company spends, but how intentionally it invests. Careful capital allocation, disciplined spending, and clear return expectations are rewarded. Businesses that avoid flashy but unproven bets in favor of focused, incremental investment are gaining credibility. Risk management has become a visible component of success. Companies are expected to understand their vulnerabilities and plan for uncertainty. Scenario planning, financial buffers, and reversible decisions are no longer optional tools. They are signs of maturity. A successful business is one that anticipates risk rather than being surprised by it. Investor expectations reflect this broader change. Markets are increasingly rewarding companies that demonstrate consistency, transparency, and financial discipline. Volatile performance driven by optimistic projections is less attractive than steady execution. Success is tied to trust as much as to numbers. Technology and innovation still play a role, but the framing has changed. Innovation is expected to strengthen the core business, not distract from it. Companies are judged on whether technology investments improve efficiency, resilience, and customer experience over time. Innovation that looks impressive but fails to deliver lasting value is no longer enough. There is also a cultural shift inside organizations. Leaders are redefining success for their teams. Instead of celebrating only aggressive expansion, they are rewarding thoughtful execution, risk awareness, and long-term thinking. This changes how decisions are made at every level of the company. Importantly, this changing definition of success does not signal a lack of ambition. Businesses still want to grow, compete, and lead their industries. What has changed is the understanding of what winning actually looks like. Winning now means building something that lasts,